Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 25th of October. I'm Daniel Lam, your host for the podcast. Over the last 36 hours, both our internal and external clients were occupied by anxiety as they saw the US 10-year yield crossing the 5% mark, something that had not happened in a long time, feeling almost alien. And the famous starting line in the Star Wars movie just popped up in my mind. A long time ago in a galaxy far, far away. In the podcast yesterday, we talked about the sharp rise in US 10-year yield, leading to the negative correlation between bond yields and equities. So when will we see fading strength in US 10-year yield? Well, over the near term, we are unlikely to see a sharp fall in US 10-year yield. The recent growth and inflation data have been stronger or higher than expected. US retail sales remained resilient, and alternative US data, such as US credit card total spending, has been registering positive growth again. Now, treasury issuance is another key factor. However, the increase in treasury supply, or the likely increase of that, would mean upward pressure on yields. Now, a counteracting factor could have been the tone of the Fed. Now, a few weeks ago, there was some dovish tilt from several Fed members. But the most recent speech from Jay Powell showed that the Fed is still, quote-unquote, resolute in its commitment to bring down inflation to the 2% mandate. And that leads to a murkier picture from the Fed. Now, what is more convincing is the sharp divergence between US Treasury yield and the S&P 500 earnings yield and dividend yield. That is showing increasing value in bonds versus equities. And indeed, if you look at the 20-year chart on the US 10-year yield, a level around 5.1 to 5.3% is a very good level to be adding bonds. But in the short term, many investors are staying cautious, noting the strong momentum of the bond yield. All that means we are likely to see high volatility in risky assets over the next few weeks. We believe investors should stay nimble and should consider adding to a diversified set of assets, such as DMIG government bonds, or defensive equity sectors such as US healthcare. At the same time, they should also consider the high-quality growth areas in case the market turns for the better, such as US technology and communication services sectors. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.